We are Sawyer Fielding, Chartered Surveyors who specialise in helping homeowners affected by the threat of compulsory purchase. As the saying goes, nothing is certain in this world but death and taxes. This video is about capital gains tax and specifically about a relief that applies to compulsory purchase. Now, don't get too excited, not that tax is ever exciting. The available relief is not to avoid paying tax, but merely to delay it. Let's start with the basics. What is capital gains tax? Well, put simply, it's tax payable on the profit made on an asset, such as a property that has been held as an investment. What that does mean is that if you've lived in the property you are selling ever since the date you bought it, there's no tax to pay. If that's you, you may want to stop watching now and check out one of our other videos instead. If, however, you will have a liability, perhaps you're a landlord, stay tuned. So how much is the profit? Well, it's not as simple as how much you sell it for minus what you paid. That's a good thing too, as the reason it's not that simple is because of allowances. An allowance is something that reduces the amount of profit that tax is levied on. The smaller the taxable profit, the smaller the tax. That's why, for example, lots of landlords choose to own properties in 4 different names, that being the maximum allowed. It means there are 4 times the allowance, which really knocks the taxable profit down. There are other allowances as well relating to things like money spent on improvements and periods the property is let for. Whilst we'd love to advise you on the detail, we're not qualified accountants, so please do direct any specific queries to them. The number crunchers will know their stuff better than we will here. So how does compulsory purchase factor in here? Well, if you're losing your investment against your will, it would be unfair for you to have to pay tax within what is now 30 days, reducing the amount you have to invest in another property. The law recognises this, so allows you to roll the tax into a new investment. If you pay in your entire sales proceeds, you won't then pay the tax due until you sell the replacement property. That means you'll start that purchase with a tax liability from the old property, but it won't be payable until you sell the new property. If you pay in part of your sale proceeds, there may be tax on the remainder. To qualify for what is known as capital gains tax rollover relief, there are of course hoops to jump through. Your sale has to be to an authority who could or have made a compulsory purchase order, like a council. Sometimes other buyers can get authority from HMRC for their purchases to qualify as well, but do check this if you're selling to perhaps a developer or housing association. Your purchase also has to be within 1 year before you sell, or up to 3 years after. And of course, you need to inform HMRC you want the relief when you sell the property subject to CPO. Again, please remember that we are not chartered accountants, we're chartered surveyors. Do take advice from a qualified tax advisor, and if they aren't aware of capital gains tax rollover relief being available for some sales on compulsory purchase terms, point them our way. We'll direct them to the appropriate legislation to check out. Hopefully that has proven helpful. Please do check out our other videos at www.sawyerfielding.co.uk/videos. If you would like to talk to us in person, we're a friendly bunch, so please do get in touch. We can be reached on 020 3011 5300, or you can email us at info@sawyerfielding.co.uk.